It's Friday, 5th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the French government on the brink, what this coming Monday's no-confidence vote could mean for the bond market outlook. But first, fresh-ish off a plane from Asia, Neil Shearing, Group Chief Economist, joins me to run through the week in global macro and markets. Hi, Neil. How's it going?
Yeah, good. Thanks, David. The emphasis being on the ish. Fresh.
Right.
Ish.
There is a lot to cover. We have to start, though, don't we, with that US jobs report. It was out a short while ago. A big miss, bond yields down, dollar down. How bad was it?
Well, it wasn't great, was it? So the 22,000 increase in payrolls employment last month in August, but obviously downward revisions in previous months, and the news that payrolls actually fell 27,000 in June. So the first monthly fall in payrolls that we've had, I think, since late 2020, the kind of depths of the pandemic. So not great. And it reinforces this idea that hiring in the labour market has stalled over the summer, potentially in response to the uncertainty caused by the tariffs. But, and this is quite a significant but, the unemployment rate only ticked up from 4.2% to 4.3%. So only a minor increase in the unemployment rate. And that again speaks to something that we've been discussing recently, which is what's happening in the labour market is as much about the weakening supply of labour as it is weakening demand. We're seeing softer demand, less hiring of workers, but also labour supply becoming restricted in response to the immigration crackdown in the US. Hence, we only get a relatively modest increase in the unemployment rate. Now, put all that together, and I'm sure the question you're going to ask me is, so what does all that mean for the Fed? And we've seen, as you say, big move down in yields, particularly at the short end of the curve, just as the payrolls numbers were released, and markets starting to price in a greater probability of a 50 basis point cut. I find that difficult to believe at this stage, actually. I think that's a push. 25 basis points now nailed on. As we've discussed on the podcast last week, the Fed backed into a corner on that one anyway, and this employment report giving it more ammunition. But I don't think it's quite as bad to justify a 50 basis point cut.
Obviously, I mean, the picture is darkening, isn't it? We had Canadian jobs data at exactly the same time as the US numbers were coming out. Also not great news. 66,000 jobs lost in August. The unemployment rate apparently rising to a 4-year high. What we're looking at, it seems, are jobs reports reflecting economies that are operating under Trump's tariff regime. How much are these tariffs going to hurt? I mean, how much more pain can we expect? Because the narrative does seem to have shifted a bit since the tariffs have come in, that maybe, they're not going to be as damaging as some had originally feared. I mean, are we going to get much more pain on this front?
We've argued since the start of the trade war, haven't we, that for the US in particular, imports of goods are equivalent to only 15% of GDP. So even if you get a large increase in tariffs, it's not going to necessarily push the US into a recession. So we never really bought the idea that the sky was going to fall in as a result of these tariff increases. But by the same token, the tariffs themselves and the uncertainty generated by the tariffs causes some economic pain. And we're seeing that play out. We're particularly seeing it play out in the manufacturing sector. Now, that's ironic, isn't it? Because the whole point of these tariffs from the perspective of President Trump in the US was to try and bring back manufacturing jobs to the US. Well, since the start of the year, manufacturing employment's fallen by 78,000 workers, 78,000 fewer workers on the payrolls in the manufacturing sector since the start of the year. So it looks like there are particular sectors that are being hit, and employment in particular sectors that are exposed to tariffs that are getting hit hardest. Now, you mentioned Canada. It's interesting in Canada. It shows that it's not just the US that's being affected by the tariffs and the uncertainty caused by the tariffs, but Canada is too, which is what you'd expect given how integrated Canada is into US supply chains. And of course, outside of USMCA compliant goods, there's been a steep hike in imports on Canadian goods by the US. We've had a view for a while that there'll be a cut in interest rates in Canada in September and December. That September rate cut now fully priced into markets, and markets starting to come around to the idea there'll be another cut in December. So potentially the market moving in our direction there.
For the coming week, just staying on these tariff effects, for the coming week, we have got US inflation data coming. What's the expectation there? We're going to see further rises?
Yes, as you say, August CPI due over the coming week. We've penciled in another increase in core CPI prices of just over 0.3% month on month. So another target inconsistent increase in prices, if you like. That would keep the annual rates broadly unchanged at about 3% year on year. But investors should be paying attention to the composition of the CPI numbers. In July's release, core goods CPI was relatively soft, but it was core services where we saw an increase. And obviously, potentially that's even more troubling for the Fed because you can rationalize increases in core goods prices through tariffs, but clearly tariffs not playing a role in driving up services inflation. So yes, another increase of about 0.3% month on month in the core CPI numbers, but pay attention to what's driving that. Is there a switch back from services towards goods, or is services inflation staying strong?
One impact of all of this jobs data, and actually we had this JOLTS data earlier in the week, is this fallback in very long bond yields. I know you're getting lots of questions while you were in Asia talking to clients about what's happening at the long end of the yield curve. They have come back down a bit, but it is clear, isn't it, that the bond market does remain unsettled. Even if this latest flare-up sort of calms down, there are forces in play that aren't going to go away, right? I mean, I think the other way I want to frame it perhaps is by asking, is there scope where we are now for a meaningful drop in bond yields?
Well, in a sense, the events of the past week or so give you a playbook through which long yields might start to drop back. And that is to say, it could happen if we start to see a meaningful deterioration in the economic data. You're right, earlier in the week, we've got that JOLTS data that were pretty soft, that paved the way for a drop back at the long end of the curve in the US. And then we had another leg down today on the back of the payrolls numbers. So it just goes to show that the macro data still matter. It's not just about kind of fiscal policy or Fed independence or concerns around kind of institutions in the US that are driving up the long end of the curve. The economic data is still playing a role. But I do think if we take a step back, there are clearly pressures building at the long end of the curve. And I think they're twofold, and in a sense, they're related. The first is there is a growing acceptance, I think, that fiscal policy is going to remain relatively loose. Deficits are going to remain relatively large. Debt burdens are already relatively large too. There's a supply versus demand dynamic playing out at the very long end of the curve. And a view that larger deficits for longer will mean higher borrowing costs, particularly at the long end. And then allied to that, you have growing attacks on central banks in general and the Fed in particular, and potentially a sense that might affect inflation expectations further out. We might be in a world where central banks are under pressure to set interest rates lower than would otherwise be the case against the backdrop of large fiscal deficits. That contributes to higher bond yields. So there are clearly pressures building at the long end of the curve. I don't think we're at a crisis point, by the way. I think if you look at what policymakers in Japan have been doing over the past couple of months, they've just simply reduced issuance at the very long end of the curve. And that's helped to ease some pressures there too. So that gives a playbook from which other policymakers might be able to deal with some of these pressures and strains, but they're clearly growing. They're clearly there. And I don't think they're going to go away entirely absent a marked deterioration in the economic data. And for the time being, we don't really see that.
What about in the UK, though? Its bond market, gilts at the very long end have been among the hardest hit. You have been maintaining that in the case of the UK Chancellor, showing that kind of fiscal rectitude, that commitment to fiscal discipline is key to keeping the bond market on side. It seems to have been struggling a bit over the last week or so. So talk about that disconnect.
Yes, I think the first point to say is although the UK there's been a lot of coverage of the rise in long dated yields in the UK tied into preparations for the autumn budget, which we now has the date for which has now been confirmed at the end of November. But really, this is a global phenomenon. The UK has been hit, but this really started in Japan and has been driven by events in the US and has dragged up long-dated yields everywhere. So it's not just a UK-specific problem. But as you say, fiscal rectitude is key. And Rachel Reeves, the Chancellor, has been absolutely crystal clear in her commitment to her fiscal rules. But I think the issue for the UK government is that there's a sense starting to build in markets that they don't really have a plan for how they're going to get there. So yes, it's clear that the Chancellor is committed to her fiscal rules, but there's not really a strategy, a plan to ensure that the government meets them. So credible estimates, including by ourselves, suggest that there might be a shortfall. Chancellor might be facing a shortfall of about £20 billion against her fiscal rules. So she needs to find £20 billion or something of that order of magnitude in order to meet the fiscal rules. But how's she going to do that? Is it going to be through tax increases? In which case, which taxes? Because the government has already ruled out raising the big three taxes, income tax, national insurance and VAT. Is it going to be spending cuts? And I think the markets, that's where the markets would like to see efforts focused, but that would almost inevitably require tackling Britain's welfare bill, and there's already been a backbench rebellion against that. It's a similar echoes to events in France, really, that governments are talking a good game on the importance of fiscal rectitude and responsibility, but struggling to implement that in practice. And I think that's played into some of the pressures that we're seeing at the long end of the curve. Now, I think I wouldn't want to overplay all of this, by the way. We've seen over the past couple of weeks some voices in the commentariat suggesting that the UK might need an IMF bailout, including, dare I say it, by former Prime Minister Liz Truss, who's ironic given the mess that she made of economic policy in her 40-odd days as Prime Minister. The UK does not need an IMF bailout. That is not where the UK is. But a bit of fiscal austerity, though it has a bad name, particularly focused on spending restraint, would not go amiss, I don't think.
And a growth plan to back it up.
And a growth plan to back it up. And we've written a lot about this over the past few years. The point with a growth plan is that it's got to be focused on the supply side. It's got to touch on a lot of areas. And it needs to address fundamentally the fact that the UK consumes too much, saves too little, and as a result, invests too little. And that plays into weak productivity growth.
Okay, finally, I do want to get your perspective on what we saw in China this past week. First, we had Xi Jinping, Narendra Modi, and Vladimir Putin literally hand-holding in Tianjin at the Shanghai Cooperation Organization meeting. And then a day later in Beijing, we had this grand military parade marking the 80th anniversary of the end of what they call the anti-fascist war. The Communist Party certainly knowing how to put on a parade to send tanks through downtown Beijing. There has been this outpouring of rhetoric accompanying all this on the Chinese side, but also from Western sources about how these optics are all a reaction against Trump's unilateralism, about how this is China positioning itself as a defender of multilateralism, but also that what we're seeing here is the emergence of a new world order. So do me a favor, cut through all of that language and from a global macro perspective, tell us what we're seeing here.
Dare I say, I don't want to keep plugging the book, but this speaks to exactly, it's a very visceral representation of what the fractured age looks like, right? You have China and a bunch of its allies in carefully choreographed displays of unity with carefully crafted messages with thinly veiled jibes at the US over the course, as you say, of two events over the past week or so. I think a couple of points worth making. The first is that, yes, China's trying to position itself as the defender of multilateralism, but I think the one point I would make on that is that it's multilateralism on China's own terms. When you look at the free trade deals, for example, that China is pushing, they're all on China's terms, which you might say fair enough, that's to be expected. But this is not really multilateralism as we in the West would come to think of it, with kind of lower trade and free access and market liberalization. It's really about opening up markets for Chinese exporters. The second is that India has been in focus clearly over the past week or so, with Prime Minister Modi making his first visit to China for 7 years. You said those extraordinary scenes holding hands with Putin at the SCO. As you said, I've just come back from Asia. Lots of questions about whether that now signals India moving much closer to China, potentially even just aligning with China within these two blocks that we've sketched out in the global economy, a US bloc and a China bloc. It's clear that the relations between Delhi and Beijing have warmed. But a couple of points just to bear in mind there. First, there's still an unresolved border dispute between China and India. Second, we're seeing that morph into other areas too. Big concerns now about water security in northern India following Chinese dam projects in Tibet, for example. Third, India remains extremely concerned about Chinese tech in its ecosystem. BYD, for example, not operating in India. Huawei not operating in India. So those big kind of geostrategic concerns about China remain in India. And finally, from a practical economic perspective, India is still extremely concerned about Chinese competition in the manufacturing sector. So, yes, it looks like India's moved a bit closer to China over the past month or so, but I still think that it's difficult to see India and China becoming firm allies over the next few years.
That was Neil Shearing on some grim jobs data, what's been happening in the bond market, and lots of signalling around the upheaval in the global economic order. Our Global Economic Fracturing Roadshow is continuing to roll. Neil and the team were in Asia this past week, but on September 17th, they're going to be in London and in New York on October 9th with in-person events to take you through how fracturing is proceeding in Trump's second term and what to expect in global macro as it unfolds. I think seats are still available for both those events, and I will link to registration details in the podcast notes. One thing to flag in the coming week: on Tuesday, we are holding drop-ins. These are our short-form online briefings, all about what's holding back the global recovery in commercial real estate. There'll be sessions in Asian and US trading hours, and I'll add links to both of those sessions to the podcast notes. Now, as Neil and I were discussing, nervous bond markets are a global story, but all that said, there is a particularly Gallic element to it all. The French government under Prime Minister François Bayrou faces a no-confidence vote this coming Monday, and all expectations are that it's going to lose. This would mark the latest unedifying chapter in the long-running crisis of France's political economy. At its heart is the political establishment's failure to get to grips with an ugly debt situation. So how does France get out of this fix, and what's next for beleaguered French bondholders? To find out, I spoke to Andrew Kenningham, our Chief Europe Economist, and I started by asking what to expect in this Monday's vote.
Well, on Monday, there's going to be a vote of confidence in the government, which has been called by the Prime Minister, François Bayrou. He didn't have to call it at this point, but he seemed to want to bring the issue to a head. And it looks pretty clear that he's going to lose the vote of confidence, so he will no longer be Prime Minister, and President Macron will have to decide what to do at that point.
What are Macron's options here? Because this isn't an isolated incident. This is part of this long-running, this ever-extending saga surrounding French politics, but at the heart of which is this question about French debt, France's public debt, and what's happening with that. So put Monday's vote and this moment in this broader political economic context.
Yeah, no, as you said, I mean, it's the underlying problem is, well, I think there are two. One is that there's a fiscal issue. The debt is high and growing, and the deficit is nearly 6% of GDP, which is going to cause the debt problem to get worse. So that's the economic problem. And then the political problem is that the parliament cannot agree on how to reduce the deficit. That's because it's split into three very broad groupings: a centrist group which supports President Macron, a far left group, and a far right group. And they're in stalemate. So this is a repeated situation. It's almost exactly what happened last year when Michel Barnier eventually had to resign, giving way to François Bayrou. But the governments are proposing very, very similar things. They're actually proposing a pretty big deficit reductions of 1.5% of GDP within a 1-year period, which always seemed implausible to most observers. But, they'll probably end up doing something much less than that.
Yeah, and I understand that part of Bayrou's proposals were to scrap the Easter Monday and Victory in Europe Day public holidays. But as you say, it doesn't sound like there's enough consensus politically for anything really to get done. You spoke about a stalemate. You said that Macron will have new decisions to make come Monday. Which way are those decisions going to go, and how do we break the stalemate?
Yes, I mean, he has three options, broadly speaking. One is that he himself could resign, and some people have speculated that he will do so. But the media suggests that's unlikely, and personally, I think it's unlikely. People don't tend to give up on jobs like that, least of all someone like Mr. Macron. The second option is to call early legislative elections, but that also doesn't seem likely to happen because it wouldn't really change things according to the opinion polls, which have basically not shifted since the last elections in the summer of 2024. So the third option is the one he's most likely to go for, which is to choose yet another prime minister. It would be the fifth since 2022, who will again try to cobble together a government, which again will not have a majority, and would then again try and put through a budget, probably ending up doing so without a vote, which the constitution allows them to do. But that would leave the new prime minister again vulnerable to a vote of confidence. So he's in a sort of holding pattern of trying to keep things together until the next presidential elections have to take place, which is in the spring of 2027. It's not that long away now. It's a year and a half. And that's kind of where we're heading for.
Okay, so then he's going to go to the French voter and ask them to make their decision. But in the meantime, there's another constituency that he has to think about, right? The bond market, the bond vigilante. We've been seeing what's happening with long bonds, particularly at the very long end of the curve. France does seem to be at the tip of this issue. What's our expectation in terms of how, you talk about these worsening debt dynamics, how that feeds into what happens with French bonds between now and the presidential elections, say? I mean, are we going to wait that long, or are we going to see a proper crisis even before that?
So there's been this sell-off in French government bonds. I mean, I tend to look at the 10-year yield as being more representative than the very long end, which I think is interesting, but not that important from the point of view of debt dynamics. So the 10-year bond yield was trading at a spread of about 50 basis points over bunds before the parliamentary elections in 2024. It then rose to sort of 80, 90 basis points, and it's been trading 70, 75 since then. I think there could be a further increase in the coming months, not particularly on Monday, because I think it's pretty clear what's going to happen next week. But there could be further increase, but not to the point that it's going to force a sort of dramatic policy change. I don't think we're heading for a Liz Truss moment in the very near term, but we do have a forecast that the spread will widen to as much as 150 basis points if you look over the next couple of years, period that includes the next presidential elections. Obviously very hard to put a sort of point forecast on any of these things, but I think the point we want to make is to highlight that there's a really significant risk of a bigger sell-off, and it would force a policy change.
Yeah, you're talking about a doubling, just to be clear, you're talking about effectively a doubling of the current spread.
Yeah.
150 basis point, is that not crisis level?
I mean, it does depend how you define a crisis, or to sort of wriggle out of the question, but a comparison would be Italy 2018 under Salvini, where the government there was running very loose fiscal policy and got into a fight with the EU and the markets, and spreads got over 200 basis points at that point, and that did ultimately lead to Italy sort of changing tack. I'm not sure it was sort of a full-blown crisis. It wasn't as acute as what we saw in the very brief sell-off with Liz Truss, never mind the sort of really proper crises that we saw back during the Eurozone crisis, where spreads were much wider than that, and there were really big question marks over whether governments were going to be able to sustain the debt, or might need restructuring. And of course, Greece did effectively restructure, and other governments had to have sort of bailouts. So I don't think we're heading for bailout territory in the next couple of years, but we're moving in that general direction, I guess.
You mentioned Italy there. I mean, you've made the point over the past few weeks that France's borrowing costs are exceeding or about to exceed Italy's. Is this a case of France doing things wrong, Italy doing things right, or a mix of both? Talk about that dynamic.
Yeah, I mean, the comparison is interesting, and I would never have expected to be forecasting that borrowing costs would be higher in France than in Italy. But there have been these really big changes. One is that in Italy, the fiscal position is better. The deficit is a lot lower than in France, and if they just keep the deficit around its current level, the debt ratio won't be rising very significantly. So they don't need to do the same kind of fiscal adjustment. And then the other really big change is that Italy has a stable government, which has a majority. It's a coalition. This is really unprecedented, literally unprecedented in post-war Italy. And Giorgia Meloni has turned out to be pretty cautious in terms of her fiscal policy. So you can also see ahead in Italy. I mean, if you think about what will happen in the next few years, it seems very unlikely there'll be a political problem before the next elections there. And it's also quite plausible that Meloni will win another term. So Italy's economy has many problems, including a massive debt stock and a sort of very, very sluggish growth and zero productivity growth over many, many years, which has not been solved. But if you're thinking just about sustainability in the debt position, it does look better and less risky than what we're seeing in France.
Meloni proved to be less radical than perhaps she appeared on the campaign trail and certainly, in her political past. Is there something that we can take from that ahead of these presidential elections in 2027 about Macron's potential opponents?
Yeah, I think Meloni is a very interesting example because really big political and policy question hanging over Europe, as it has over the US. What would happen if some of the sort of populist right-wing leaders got in control? Trump is one example where he is actually running very loose fiscal policy, but the market seem to tolerate it. In Europe, I think, particularly in the Eurozone, there's much less scope to run loose fiscal policy and get away with it because of the currency union and the fact it's not the reserve currency and so on. So I think it's a question we don't know the answer to. If Le Pen were to become the next president or Bardella, would they stick to the very irresponsible fiscal policies that they've outlined in their manifestos, or would they tack towards something more sensible, which is what Meloni has done? I mean, her rhetoric has generally continued to be pretty radical, but on many areas, her actual policies have been much less so. So yeah, that's an unknown. In many ways, Le Pen has tacked towards the center in her rhetoric, but from really quite extreme policies, including leaving the euro and the EU and so on, which she's ditched. But she's still officially advocating very loose fiscal policy.
Okay, I can't let you go, Andrew, without asking about the ECB meeting this Thursday. Very quickly, what are our expectations? But also, how does what's going on in France, these debt dynamics, how does that generally feed into thinking on the Governing Council?
Yeah, so the meeting looks like being a very uneventful one where policy rates will be left the same. The ECB said in the minutes of their last meeting that they were deliberately uninformative in the way they recorded their conversations. And I think we'll learn little from the press conference too. The France issue, I don't think will be affecting policy decisions at this point. Really, the interesting question for the ECB relating to France is how they would respond if there's some significant contagion to other countries, because they do have this instrument, they've set up, they call the transmission protection instrument, that basically allows them to buy bonds from other governments quite quickly if they think that there's what they call an unwarranted widening of spreads. So, France policy errors lead to widening spreads in Italy. They could wade in. That's something I'm sure they'll be thinking about quite carefully. What point would they do that and so on. I don't think we're there yet, but that's something that no doubt they're considering.
Andrew Kenningham on France's debt dilemma. Look out for the team's coverage of this Monday's vote. Then on Tuesday, we're holding a drop-in at 11 a.m. Paris time to unpack what's happened, talk through the next steps, and discuss implications for the bond market. I'll add a registration link to that, as well as some recent analysis all about this situation to the podcast notes, including on French versus Italian borrowing costs and shooting down talk about IMF bailouts. But that's it for this week. There is a lot happening in the coming 5 trading days, including the latest Chinese trade data, those US inflation numbers, but also Chinese CPI and PPI, and that ECB meeting. We will be back to talk about all of that and much more next week. Until then, goodbye.